I've seen people with $3 million who are terrified of retirement. I've seen people with $600,000 who are completely confident, and rightfully so. And everything you've been told about retirement readiness is focused on one question: how much money do you have? And while that question does matter, it's not the most important question. And here's what might surprise you: you don't need 2 or 3 or $5 million to be ahead of the vast majority of Americans. You don't need a pension, and you definitely don't need to own your own house outright. But there are a few things you do need to have. The problem? Financial advisors rarely talk about these things because they're harder to measure, harder to sell, and take more effort to fix if you don't have them. But if you do have them, you're ahead of most people approaching retirement regardless of your account balance. I've worked with hundreds of people getting ready to retire, and I can tell you this: the people who feel most confident about retirement aren't always the ones who should be. And the people who are worried, they're sometimes in the very best of positions. Now today, I'm going to show you 5 signs that you're ahead of most retirees, including the 5th one that's crucial if you're planning to retire in the next 2 or 3 years. And I'm willing to bet that you have more of them than you think. And in this latest episode of the Financial Prof series, I'm going to show you why. Alright, so the first sign you're ahead of most retirees is simple. You've actually calculated your retirement number. Not a vague guess, not "I think I'll need around 1.5 million," but an actual calculated number based on your specific spending needs. Now here's the shocking reality. According to a 2025 bank rate study, 30% of baby boomers, people who are already at or very near retirement age, don't know how much they need to retire comfortably. Think about that. Around 1 in 3 people approaching retirement have no idea what their target even is. But you? If you've sat down and done the math, if you know you need 75K per year in retirement, which means roughly 1.9 to 2.25 million using the 4% rule, you're ahead of a huge percentage of Americans. Because here's what calculating your number actually means. You understand the difference between gross needs and net needs. You've calculated Social Security, pensions, or other income sources. You know that if Social Security covers $30,000 of your 75K need, then you're going to need to generate another 45K from elsewhere, and you can start to plan for what that elsewhere is. And most importantly, you understand that your number isn't static. It adjusts based on inflation, healthcare costs, and lifestyle changes. According to the 2025 Federal Reserve Survey of Household Economics, only 35% of non-retirees feel the retirement savings plan is on track. That means almost 2/3 either don't have a plan or don't think they're going to hit their goals. Now, if you know your number and you're working towards it, you're already in the minority. But knowing your number is just the beginning, because sign number 2 is about what you're doing to protect the money you already have. Now, sign number 2, you have a tax strategy in retirement. Most people, you see, think the taxes end when their paycheck stops. But that couldn't be more wrong. Most people have at least some dim glimmer that they're going to have to pay something in taxes in retirement, but very few know what that looks like. And if you have a tax strategy for retirement, you're ahead of most. Here's what that actually means. You understand the difference between traditional and Roth accounts. You've thought about which accounts to tap first and when. You know about Roth conversions. You understand required minimum distributions and how they'll affect your tax bill. And you might even know about strategies like qualified charitable distributions. But here's the problem. According to Northwestern Mutual's 2024 Planning in Progress study, only about 30% of Americans believe they have a tax-efficient retirement plan. That means 70% either don't have a tax plan or they're not confident in the one they do have. And many of them are paying thousands more in taxes than they need to be. Quick example. Let's say you retire at 62 with 600,000 in a traditional IRA. You're living off savings until Social Security at 67. Your income is low. Your tax bracket might drop from 24 to 12%. This is the perfect time to consider a Roth conversion. Maybe 12% tax, and then that money grows tax-free forever. No RMDs, no taxes in retirement, and it passes to your heirs tax-free. But the average retiree doesn't do this. They wait, and then at 73, RMDs force them to take large distributions. They get pushed into higher tax brackets. Medicare premiums spike. They end up paying 15 to 20% more because they didn't plan. Now, if you've thought about tax bracket management, and if you understand Roth conversions, and if you're strategically planning withdrawals to minimize your lifetime tax bill, you're way ahead. Tax strategy protects what you've already saved, but sign 3 protects you from something most people don't even think about. Sign number 3 that you're ahead of most retirees: you have a long-term care plan. Here's the data that should terrify every pre-retiree, and I'll even put myself in this. According to the U.S. Department of Health and Human Services, 70% of people over 65 will need some form of long-term care before they die. And that's in today's numbers. By the time I get to over age 65, I imagine it's probably going to be even worse because life expectancies keep growing. 70% is the majority. That's huge. So let me just repeat. 70% will need care, and only 3 to 4% have insurance for it. That gap is catastrophic and is bankrupting families every single day. According to Genworth's 2024 Cost of Care study, here's what long-term care actually costs. A home health aide averages about $77K per year. An assisted living facility costs about $70.8K annually. A private nursing home room is over $127,000 per year, and Medicare doesn't cover it. Medicaid only kicks in if you're essentially broke. So for most people, it comes straight out of their retirement savings. And according to data from the American Association for Long-Term Care Insurance, the average nursing home stay is about 2 to 3 years. So do the math. 3 years in a nursing home at $127,000 per year is almost $400,000. That can obliterate a retirement plan in a matter of a couple of years. I'm not saying everyone needs long-term care insurance. Some people self-insure, setting aside those funds to grow in a separate type of account. And then there are those who have family care plans with clear agreements and financial structures in place. But if you have any plan, if you've acknowledged this risk and you've actually done something about it, you are ahead of 96% of Americans. Long-term care planning protects your assets and your family. But if you want to be truly ahead, you'll need sign number 4. And if you're wondering how your specific situation stacks up, and you want to see exactly which of these 5 signs you should focus on, I've created a free, personalized 5-minute retirement plan video program that's tailored to your numbers. You just fill out a quick form, the link is in the description, and I'll record a video for you using your data and shoot it right to your email inbox. So again, the link is right here in the description. I would encourage you, if you're wondering where you are, fill it out. We'll give you some actionable insights, and you can move forward with that. All right, sign number 4. You are not relying on a single income stream. In other words, you have multiple income streams for retirement. According to the Fed, on their 2025 report on economic well-being, 81% of retirees have one or more sources of private income in addition to Social Security. But here's the problem. Social Security still makes up the majority of income for most retirees. According to annuity.org, 37% of men and 42% of women rely primarily on Social Security for their income needs. Single source dependency can be a significant problem, especially if your costs are outstripping your income. But if you've built multiple income streams, if you have Social Security, a pension, an annuity, retirement account withdrawals, rental income, you have flexibility. And here's why this matters. Sequence of returns risk. If the market crashes in the first few years of your retirement and you're pulling from a single 401k that's poorly allocated, you could deplete your account 30 to 40% faster than planned. But if you have multiple streams, you have options. If the market tanks, you take more from your rental income, or maybe you take Social Security early. Help bridge that gap. Maybe work part-time for 6 months at a hobby job. Multiple income streams also gives you tax flexibility. You can pull from Roth accounts in high income years to avoid IRMA surcharges. You can take capital gains in lower income years and perhaps stay in that 0% capital gains tax bracket. And here's an interesting trend, too. According to a recent report from Goldman Sachs, 34% of retirees work part-time to generate an additional income stream. So if you've already built 2 to 3 plus income sources into your retirement plan, you're ahead of most Americans. You have options, control, security. Now, multiple income streams give you flexibility and protection, but sign number 5 is truly a crucial step, especially if you're looking at retiring in the next few years. So what is that 5th and final sign that you're ahead of most retirees? You've actually stress tested your retirement plan. And no, I don't mean you've looked at your account balance and thought, yeah, this seems like enough. By stress testing, I mean you've run scenarios. You've asked, what if the market drops 30% in the first year of my retirement? Or what if I live to 95 instead of 85? Or what if inflation stays closer to 4 or 5% instead of 2 or 3%? Or what if I need long-term care for 5 years instead of 2? What if my spouse dies earlier than expected and I'm left as a single filer in higher tax brackets? The dreaded widow's tax, as it's called. And most importantly, you've adjusted your plan based on those scenarios. Here's the reality. According to a recent survey from the American College of Financial Services, 2/3 of Americans between age 50 and 74 don't have a formal retirement plan. 2/3 of people who are approaching retirement are winging it. But even among the third who do have a plan, most of them have only planned for average scenarios. They assume 7 to 9% annual returns, 2 to 3% inflation. They never talk about expensive care or life expectancy or things that could throw that plan completely off base. That's not a plan, that's a hope. Stress testing means you've planned for the worst case scenarios, and more importantly, you know how you'll survive them. Here's why this is critical. Sequence of returns risk is real. If you retire this year, 2026, and the market crashes 20 to 25%, you could run out of money 10 to 15 years earlier than expected. But if you're stress tested, then you know you'd already cut spending by 15%. You might delay Social Security claiming another year, or perhaps claim it earlier if that's the right plan for you, because it will help put a little ease on that portfolio instead of drawing off of it while the markets are down. So here's a test for you. If the market crashed 25% tomorrow, would you know exactly what to do? Or if your healthcare doubled in cost, would you know what to do? Or if you lived to 95 instead of 85, would you know what to do? If you can answer those questions confidently and quickly, then you've probably stress tested your plan. So let's recap our 5 signs that you're ahead of most retirees. Sign number 1, you know your actual retirement number. Not a guess, but a calculated target based on your needs. Number 2, you have a tax strategy in retirement. You understand Roth conversions, RMDs, and tax bracket management. Sign number 3, you have a long-term care plan, whether it's insurance, self-funding, or a family arrangement. You've acknowledged that 70% of people will need care, and only 3 to 4% have insurance for it. Quick bonus tip, many states also offer a tax credit or tax bonus if you are buying a private long-term care policy in that state. Okay, sign number 4, you have multiple income streams. You're not relying on just one account or, one Social Security claim to help you out in retirement. And sign number 5, you've actually stress tested your plan. You've said, what if, and then actually run the numbers based on those what ifs. So how many of those do you have? If you have more than 2 or 3, you're probably in really, really good shape. But here's what I want you to remember. The signs that matter more than your account balance are being prepared. And that's what today's video is all about. Because retirement isn't just about having money. It's about having clarity. It's about having control and confidence in the plan you've built. So, if you would like a personalized analysis of your retirement plan, if you want to know exactly which of these 5 signs you have and where I'd focus if I were in your shoes, go ahead and click the link in the description, answer a few quick questions for me, and I'll create a custom 5-minute retirement plan video for you and send it right to your inbox to show you right where you stand and what I would do. If you enjoyed this content, I'd be grateful if you subscribed. We release new content weekly aimed at demystifying complex financial topics like this. In the meantime, thanks for watching, and I'll see you out there.